All right, so welcome to this fair lending seminar. It's a training. We're going to discuss fair lending laws today. We're going to go ahead and get started. We are recording this session today so that people can enjoy it later. My name is Adrian Garcia, and I'm the Director of Fair Housing and Commercial Property for the Pennsylvania Human Relations Commission. The first thing that I will state is that fair housing in Pennsylvania is a right. It's a right that all inhabitants of the Commonwealth have, not only under the Fair Housing Act, but also under the Pennsylvania Human Relations Act. Our goals today for the training are to provide an overview of the Pennsylvania Human Relations Commission. We're going to identify relevant fair housing laws, discuss protected classes, discuss discriminatory practices, explain reasonable accommodation and modifications for individuals with disabilities. We're going to share an overview of the complaints and the complaint process, and we're going to explore opportunities to affirmatively further fair housing and answer any fair housing questions that you might have. And obviously, we're going to focus our presentation today on fair lending. So the Pennsylvania Human Relations Commission is the leading civil rights enforcement agency in the Commonwealth. We are an independent, investigative, neutral body that enforces the anti-discrimination laws. So laws like the Pennsylvania Human Relations Act, the Pennsylvania Fair Education Opportunities Act, as well as the federal code. We also promote equal opportunity for all in Pennsylvania. And one of the ways that we do that is through our key partnerships. Community Relations and Activities Task Force is one way. The PHRC advisory councils, I think at this point we have about 12 of those advisory councils spread throughout the Commonwealth. And they're kind of our pulse on the community, things that are going on in their community. You know, could it be housing issues they might be looking at in their community? Are there reasonable accommodation issues in their community? So these individual advisory councils act on behalf of their community to address those concerns through events that they put together or through partnerships with the Pennsylvania Human Relations Commission. We also work with local Human Relations Commission, and we also are part of the Affirmatively Furthering Fair Housing Task Force. And then other advocacy organizations that aren't necessarily enforcement entities, they're not fair housing entities, but they are agencies, many of them social service agencies, that are working on behalf of individuals that would otherwise be marginalized from access to housing. We also provide training as we promote equal opportunity for all. This training we provide in schools and employers, community organizations, housing providers, local officials. Those can be requested online at the address that you see there on your screen. Our jurisdiction is pretty much the Commonwealth of Pennsylvania. We have 3 regional offices. In the dark blue, you see that would be our Pittsburgh regional office territory. The light blue would be our Harrisburg regional office. And then our southern eastern portion, kind of a baby blue color, is our Philadelphia regional office. And we have 3, those 3 offices are, they have personnel, obviously the regional director, as well as investigators and housing supervisors and employment investigative supervisors in all 3 offices. And so with regards to what our laws cover employment, housing, which is what we're going to focus on today, commercial property, public accommodations, and education. So why is fair lending important? Well, we need to ensure that all individuals are provided access to credit in a fair and equitable manner through compliance of the fair housing laws. And many times with fair housing laws, we forget about fair lending. We forget that the Fair Housing Act covers any and all housing transactions, including lending. We're also going to discuss the fair lending laws and regulations, but we're also going to look at disparate treatment versus disparate impact and discrimination risks in the fair lending sphere. So first, let's cover fair lending laws. There are multiple ways that these laws interact together. There's the Equal Credit Opportunity Act, or ECOA, Regulation B also, prohibits discrimination in any aspect of credit transaction. So consumer credit, extensions of credit to small businesses, corporations, partnerships. Then you have the Fair Housing Act, which prohibits discrimination in residential real estate transactions, making loans, if you're buying, you're building, you're repairing, improving, you're purchasing real estate, you're selling, you're a broker, you're appraised, it's all covered under the Fair Housing Act, renters as well. And then the Pennsylvania Human Relations Act, just to give you an idea of how they interact, it's basically a mirror of the Fair Housing Act. And I'll show you the differences between the acts in terms of protected classes in a future slide. But it also prohibits discrimination in residential and commercial property transactions. And again, making loans to acquire, construct, rehabilitate, repair, or maintain. And in the process of leasing, selling, financing, or otherwise denying or withholding accommodations, housing accommodations. So the fair lending laws, they cover the credit process, the pre-loan, closing, the advertising and marketing of such products, the loan application itself, the underwriting and pricing guidelines. All of these are covered under the fair lending laws. And they also cover the post-loan closing. So the loan servicing, loan modifications, foreclosures, and there'll be a couple of case examples that I'm going to share later on in this presentation of different types of cases that have been, case law that has been made apparent throughout the years. There's one that's actually fairly recent. But first, let's compare the different lending laws and the protected classes they cover. So you're looking at all fair lending laws prohibit discrimination on the basis of race, color, national origin, and sex. So that's all fair lending laws. And then we look at the protected classes offered by ECOA, which include classes that are not covered under the Fair Housing Act, like marital status, right? Age is not included in the Fair Housing Act. It is included in the Pennsylvania Human Relations Act. Public assistance income, which is also known as source of income, but they're looking at that government subsidized type of income, is also included as a protected class in ECOA. And then the good fair exercise of rights. In our industry, we call that the retaliation. So individuals that exercise their rights by reporting anomalies to credit consuming agencies. So if they cite the Truth in Lending Act, the Fair Credit Reporting Act, the Fair Debit Collection Practices Act, all of these are protected activities. And so what we would look at when we see a case like that and somebody were to bring that to our attention, we would look at that under the protected class of retaliation. Let's look at the FHA and look at other protected classes that are included there, which include familial status, handicap, disability, religion, and retaliation under the FHA. So that means that if you file a complaint, that's a protected activity. And if because you did that, someone decided to take adverse action against you, then at that time you could file a complaint for retaliation because it was a protected activity. And the same thing happens from, let's see, pardon me, I think I have some other attendees. Yes, I do. All right, I'll just wait till they get connected. Welcome them into the fold. Let's see. All right, is everyone in the room? There's Amanda, okay. And Lisa, can you hear me okay?
Yes, I can. Thank you.
Thank you. Amanda, can you hear me okay?
Yes, I can.
Very good, very good. Well, we went ahead and got started. I was a stickler for time, and out of respect for everyone's time, I wanted to make sure that I was started on time. But we're still at the very beginning here, kind of going on about the different fair lending laws and the protections that they offer, the protected classes that they protect. And so we started off by saying that all fair lending laws protect against discrimination due to race, color, national origin, and sex. Then we dropped down and looked at how ECOA looks at their protected categories, which include marital status, which is not a protected class in the Fair Housing Act, age, also, which is not a protected class in the Fair Housing Act, and then public assistance income, or what we like to call source of income. Sometimes you'll see that hyphenated, and then what we call retaliation. ECOA calls a good faith exercise of rights, which is you exercising your right to ensure that you're not being discriminated. And if you report such a claim of discrimination, either in the, citing the Truth in Lending Act, the Fair Credit Reporting Act, or the Fair Debt Collection Practices Act, that would be looked at as retaliation if someone took adverse action against you. And then we flipped over to the Fair Housing Act protected categories, which include familial status. And you notice that ECOA does not include familial status. It includes handicap disability, it includes religion, and retaliation, which again is basically the same as what ECOA is citing. The difference being that when we cite it, we're looking at a protected activity, and that is to say under the Pennsylvania Human Relations Act or under the Fair Housing Act. The fact that you filed a complaint is a protected activity. And if someone were to take adverse action against you because of that, then you would be able to file a complaint under retaliation. Then when we look at the Pennsylvania Human Relations Act, you'll see that there are some similar protections. Of familial status is cited, handicap disability, retaliation under the Fair Housing Act, age 40 and above, ancestry is also covered, religious creed, use, handling, or training of a support animal or a service animal is also covered, and it's been covered since the 60s, 20 years before the Federal Fair Housing Act actually covered it. So we'll go on to the next slide here. So given that we understand what the protected classes are within the fair lending laws, what does it prohibit? Well, they state that lenders may not fail to provide or provide different information or services in the lending process, including credit availability, application procedures, or lending standards. They can't discourage or selectively encourage individuals who inquire to apply for credit. And sometimes that happens. You get excited, or the lender may get excited about this prospective buyer or someone that wants to come in for a loan, and because of their income, they want to encourage them to buy certain products or get a certain loan, but they may not treat the next person coming in the same manner or with the same enthusiasm. They can't refuse to extend credit or use different standards. They cannot vary the terms of credit offered. They can't use different standards to evaluate collateral. And they can't treat a borrower differently in servicing a loan or declaring default, or use different standards for pooling or packaging loans in the secondary market or broker relationship. And one of the things that I've seen in my past experience is that we've seen, I was with a CDFI, and in that CDFI, we did first-time homebuyer programs. And I remember being at a mixer, and I heard one of the lenders say, yeah, I don't encourage any of my clients to go to those programs. And so I started kind of doing research and found that a lot of people were steering people away from those programs. And when you start breaking down who those programs are designed to help, it becomes very clear that there might be a potential violation of the Fair Housing Act. So this is something that I've picked up along the way. They also may not express a preference based on bias. So this applies to both oral and written. I gave you an example of an oral preference. They can't refuse a reasonable accommodation in credit applications when necessary to give an individual an equal opportunity to apply for credit. So reasonable accommodation might be that they need the information in Spanish. So that's a reasonable accommodation. You know, if you're looking at a post loan and this person has aged into a protected class, maybe now they became injured, you know, they had a loan, home loan, they became injured, and now their income is SSDI, and they get their money on a particular day, but their payment is due on this day. That would be a reasonable accommodation, to ask the ability to pay on a different day without suffering the consequences of a charge, a late charge. So that might be a reasonable accommodation. Again, I said refuse language access, refuse to provide a loan or provide unequal terms because of the pregnancy or family leave. There's a case later on in this presentation that I'll cite that has to do exactly with that scenario. So evaluating lending discriminations, court precedent recognizes methods of providing lending discrimination, including disparate treatment, right? And under that, there are subcategories. There's direct evidence of discrimination or overt discrimination, and comparative evidence of discrimination. So in a disparate treatment case, we look at both of these simultaneously. Not only do we look for direct evidence, but sometimes the absence of direct evidence obligates you to look for comparative evidence, to be able to have comparators. We use that all the time in our investigations. We say, okay, but what are the comparators? If I don't have direct evidence, which means I don't have someone that either said something or wrote something, said something with a witness present and the witness can corroborate, or wrote something down. I am not renting to you because of X, Y, Z. I am not lending to you because of X, Y, Z, right? And then we have disparate impact. Lenders apply seemingly neutral policy or practice equally to all credit applicants, but the policy excludes or burdens groups of people within protected classes. Right? So a simpler definition is it's a policy that seems neutral on its face, but when you apply it, it affects a person within a protected class in an adverse manner. So one example is like the one that I just gave you. This person is disabled, newly disabled. They have a loan that they've been paying for years, but now because their income stream has changed, they need an accommodation on a different date. But the policy states you must pay your loan on this date or you will be assessed a late fee. And so the reasonable accommodation asked for is for that. Even though that policy is neutral, it does, when you apply it, have an adverse impact against an individual that has a need for a different payment date because of a disability. Okay. So disparate in treatment, we usually like to call this direct evidence cases. Many times there's a written policy that states something about a preference for a protected class. Or there are oral statements. Somebody said something. Maybe they said it in front of witnesses. Maybe they said it before in front of witnesses. We've had cases here that we've investigated that not necessarily does the individual have to prove that a witness was present. It's enough once the investigation opens that you start interviewing witnesses and other witnesses begin to tell you the same story. You know, once, okay, twice, maybe a coincidence, but that third one that has a lot of weight to it. So those oral statements might be expressing a discriminatory preference regardless of any action. So here's an example. Lender provides credit card limit of $750 to individuals from 21 to the age of 30 years old, right? While providing credit card limits of $1,500 to individuals over the age of 30. Right? So there you have a difference in age, and we remember from the ECOA protected classes that age is a protected class, right? And so somebody could certainly file a complaint stating I'm being treated differently because of my age, right? You see this all. This is just me on the soapbox for a moment, but you still see this in insurance relationships. Everyone gets grouped into age groups, right? And that's how you're rated. That and your credit and your driving history, but a lot of that is pulled from risk factors. And so if you're between the age of 16 to 25 years of age, you are in the highest risk factor for accidents. And because of that, everyone, regardless of their driving history, is affected adversely by the decisions or the rating that they have. So you still have a little bit of that going on. So that example kind of illustrates overt discrimination based on age, which is what I mentioned before. Let's look at another one. This is one that has to do with comparative evidence of discrimination. Evidence of discrimination when a lender treats a credit applicant differently, and the difference in treatment cannot be explained as a legitimate non-discriminatory reason, which is one of the standards that we look for. It's like if somebody files a complaint and we then send a copy of the complaint to the respondent reviews it and is required to answer that complaint within 30 days, and they are supposed to do so by addressing every bullet point on the complaint. And hopefully they're able to demonstrate a non-discriminatory reason for the treatment. You know, that's what we call that process. We call the McDonnell-Douglas burden shifting. So we start with the complaint, then the burden shifts over to the respondent to respond, then the burden comes back to the complainant to rebut whatever was said, and the investigation continues from there. Let's look at an example. And these don't require proof that treatment was motivated by prejudice or intent. It may have the impact may be the same. But let's see here, non-minority couple applies for a loan. The lender finds adverse information in the couple's credit report. The lender discusses the credit report with the couple and determines that the adverse information was incorrect and the loan gets granted. While at the same time, minority couple applies for a similar loan with the same lender. Adverse information was discovered on their credit report as well. Lender did not discuss the adverse information with the minority couple and the loan was denied. So there was a different level of service offered on a protected class. And you may ask yourself, yeah, but that's an individual, right? That's an individual loan, an individual scenario. How would they know that they were treated different? But I would submit that people go to areas or to lenders that are known in the community. They typically go to lenders within their community that have people that are from their community working in the lending institution. And so word of mouth gets around. The very reason the person goes there in the first place is because they've heard good things, because it's a bank and because it's within my community. And more importantly, I may have money there. Right? I have money saved there. And so automatically I would go. And so that's how that gets around. Also, one thing to remember about discrimination is that it's a subjective form. You know, I've said this many times, you know when somebody is discriminating against you. There's a feeling that you get that you're almost in denial. You're like, nah, they didn't mean that. And then you start thinking about it, and it's like, I think I was just discriminating. And you do kind of a double take because you're not sure and you don't want to go there. Most people don't want to go there first. That's not their first instinct to accuse somebody of racism, right? But you know how you're treated on a day-to-day basis by family members, colleagues, and strangers. So you have a point of reference to be able to ascertain whether someone's treating you adversely, or at the very least, you have the right to find out if it's true. If that's what you're feeling, you have the right to file. I say this to also say that just because someone files a complaint for discrimination doesn't make it true, but it doesn't take away their right to find out if they were discriminated. And the investigation would bear that out using, you know, McDonnell-Douglas or other investigative tools and techniques. So just because somebody files a discrimination doesn't necessarily make it true, but it doesn't take away their right to be able to file. That's the right guaranteed under the law. Any questions to this point? And you can feel free to put them in the chat if you'd like, and I'll get to them as quickly as I can. Let's see here. We'll go on to the next slide if there are no questions. So let's look at disparate impact. This one's a little bit harder to prove, right? And it's been made harder by movements in the government structure, in the U.S. government structure as of late, well, as late as 2 years ago, at least. So disparate impact. You got to evaluate whether a policy or practice is justified by business necessity that was established before the policy was implemented. So some of the factors that you evaluate is bank or market specific costs or profitability. And even if you do consider those, there has to be a less discriminatory alternative to the policy. Right? And we have a scenario there. Lender states it will only make loans of $60,000 or more for single family residences. Within the bank's lending area, members of one or more protected classes, so they're either race or national origin, live in neighborhoods where property values would generally not require a loan larger than $60,000. So the policy, even though it's neutral on its face, has the disparate impact of excluding members of a protected class from applying. Right? Lender could have a no minimum loan amount and charge an origination fee on all loans as a non-discriminatory alternative. Okay, let's see. Is there any cost to the person discriminated against to file? Is there any cost to the person discriminated against to file? Well, there's no cost to file a discrimination complaint either with HUD or with ECOA or with the Pennsylvania Human Relations Commission on either side, the person filing the complaint or the person receiving the complaint. The cost would come if we found, say, probable cause, right? And we could not settle it or conciliate it, then we would take it to public hearing. There will be civil penalties assessed. There will be other penalties assessed, and it could get expensive at that point. But there's no cost to file, and I hope that answers your question, Lisa. Okay, so that's disparate impact, and the reason I say it's difficult, it's because back, I want to say during the Trump administration, they started looking at the disparate impact rule, and so banking institutions and insurance institutions began to lobby for the relaxing of disparate impact. And for a moment, it was written, the disparate impact rule was written, and additional criteria were added. There were 5 criteria that were added to the disparate impact rule. It never saw the light of day. I mean, as soon as it was announced, there was litigation against it, so it froze it in its track. It did make it harder, and it really raised the bar for individuals to be able to file a disparate impact complaint. Up until then, you could use an investigator, for example, can use not only the black and white letter of the law, but they can also use statistical information, historical information from, say, the 1930s Hulk maps, which were the redlining maps. You could use that to show a pattern of treatment that is disparate. And so right now, the federal government is still reviewing their past disparity. So you had Trump's disparate impact rule, which was frozen. So we're using I think the 2013 disparate impact rule. That's being reviewed. And once that's finished, they'll go ahead and move on to the affirmatively furthering fair housing rule as well. And we'll talk about that a little bit more as we go along. So there are some discrimination risks. All right, these are areas that lenders could kind of commit by mistake could commit some biases or some discrimination. So in their underwriting process, for example, they might appraise it excessively low, and we've all heard that. We've all heard about the appraisal bias that's going on. There's been a lot of it in the news. I know that investigators now are being trained on what to find in the case and how to investigate in appraisal bias. Had a very good conversation with an appraiser, actually, that teaches where some of the areas on the actual appraisal form, where some of the areas for discrimination could become apparent. Very good training. So that's something that's going on out there. They could also excessively have some qualifications that are excessively burdened, or some standards that are excessively burdened. There's pricing differences that occurs. Marketing, and we'll talk about one of the marketing cases here in a bit. Of course, redlining. and steering. And steering is obviously just the act of, persuading someone to do something else or to choose another home because the seller may feel they may be more comfortable in that neighborhood, or just steering them to a product that is more within their liking because people in their protected classes use this product more. At the end of the day, fair lending laws, like fair housing laws, are about freedom of choice and not having that freedom of choice being taken away from you. Now, whether or not the person qualifies for the choice, well, that's going to bear out in the process if it's an equitable process. But when we're talking about the choice and the opportunity to choose, that cannot be denied to anyone because of protected classes. So the Home Mortgage Disclosure Act, or the HMDA, which provides a lot of data that can be used to determine whether credit unions are serving the housing needs of their communities. They can assist public officials in distributing public sector investments and assist in identifying possible discriminatory lending patterns. And this is something that is used far and wide by fair housing enforcement agencies, by real estate, by lenders themselves. They like to look at that HMDA data and compare it to the efforts that they have. And you'd be surprised when you hear bankers or lenders they know what they're doing, and they know how they're using the CRAs that they have, and they know that they're trying to reach to a diverse audience. But when the HMDA data comes out and shows that in their area, certain groups are not receiving loans or being marketed to or what have you, it really is an eye-opening experience, and it keeps everyone kind of on the guests, they on their toes and guessing at, okay, well, how do I improve that? So for fair lending compliance, there are some consequences, right? Like, for example, you lose opportunities as a lender. Obviously, the ability to have complaints filed against you and lawsuits filed against you, not to mention the negative publicity. I mean, in today's day and age, if somebody chooses to file a complaint of discrimination and they file it, not only do they file it, but they can go on social media and they can call out any organization, and next thing you know, it spreads like wildfire. So that negative publicity is hard to backtrack from. Public protests, obviously, regulatory scrutiny is another one, and there are certainly examples of that. I went to a training in Philadelphia not too long ago where it was based on a settlement with Redfin, and we were talking to housing counselors and talking about fair housing and affirmatively for housing, and it was Redfin that sponsored the event as a result of part of the settlement that they had. So that's some of the regulatory scrutiny that goes on. The other one is one that we do, which is to review records. If we do a conciliation, many times we'll review records on an annual basis. Depending on how egregious the discrimination may have been, we may decide, okay, well, we're going to review your records for the next three years running. So let's see here. Pardon me while I read this question. Would I be able to provide more information on the training that a realtor provided on where we may see bias in an appraisal? I can actually do that. Yes, I think I have some information that I can email to you from this trainer. They provided that to me, so I'll go ahead and do that, Alyssa. Thank you so much for the question. Let me make a note of that because I will forget. So let's see, bias appraisal. Also, at the end of this presentation, and I'll make sure that I send this, there are resources there and the links are live and you can actually click on those and get to. So for example, you'll hear me talk about the PAVE task force, which is the study done by HUD regarding appraisal bias. So you'll see that and you'll be able to read the entire report on there as well. Negative impact on CRA ratings is another one. Referral to the Department of Justice, Department of Housing and Urban Development, business constraints, restitution, and civil money penalties. And that's, again, here's one of the things that you don't see on here, but can happen. And one of the things that we at the Pennsylvania Human Relations Commission do encourage, which is when you file a complaint of discrimination, you don't get punitive damages. So if there's a lot of emotional distress or pain and suffering, well, that's not a remedy that you can seek through this administrative procedure. But if we find probable cause on a complaint, we certainly provide the complainant their right to sue in civil court for those penalties. So not only do they get whatever remedies they can get under the PHRA, but they can take that decision over to civil court and proceed in a civil matter and get some of the pain and suffering. In fact, they had some pain and suffering. And it's important that when we talk about, well, at least when I talk about fair housing, fair lending, and the complaint process, I like to talk about it in a manner that is giving you both sides of the equation. What the complainant can do, what the respondent can do. And in many cases, that's one of the things that I know that we push for, because we know that people can't get that kind of restitution from this process. Here's one of the most recent lending cases. Trident Mortgage, they settled. This is a case that involved New York, Delaware, New Jersey, and Pennsylvania. Case settled for $24 million. And basically what it was is redlining through marketing, sales, and hiring actions. They also had some racist language in company communications, a lack of offices in minority, majority communities, and use of non-diverse advertising campaigns, targeting campaigns to majority white neighborhoods. So these campaigns, they seem benign, but when you start, this is kind of a class action. So when you start compiling, remember when I said you don't necessarily have to have the clear language, but if you have the pattern in practice, when you put the pattern and practice together, it can result in one of these cases. It could result in a systemic issue. You could look at Trident, look at their advertising, look at where they're located, see what their campaigns were, and you kind of you're able to compile enough data. On top of which, unfortunately, you don't see, in this case, you did not see Trident come back and give and offer a non-discriminatory reason or alternative, right? So many times what I tell respondents is, let's take reasonable accommodation. Reasonable accommodation is a request that somebody with a disability has a right to ask under the law, in order for them to be able to enjoy their home like anyone else that would not need a reasonable accommodation. Now, does that mean that it's automatic? No, but it does mean that they've requested that accommodation, and therefore the respondent is under the obligation to enter what we call the interactive process, which is, okay, well then how can I help you in this particular case? So let's say in a lending case, somebody can't read the documents because they're not in Spanish. So the interactive process would then require that lending institution to provide an interpreter or to provide a literature in Spanish so that the person can understand. That's the reasonable accommodation. Failure to do so would have an adverse impact against that individual. And so we've not even gotten to whether or not that person qualifies, which would be the non-discriminatory reason, right, for not lending someone money, but the fact that we're not servicing that person in providing that reasonable accommodation. Here's some other ones that came up in fair lending cases. So you have the USB Associated Bank, and this was the largest ever HUD-initiated redlining settlement. They basically, this happened in the upper Midwest, I think to the tune of 400 million. I want to say 400,000, I'm sorry, 400,000. And then you had your countrywide Bank of America settlement. More than 200,000 African-American and Hispanic borrowers who qualified for loans were charged higher fees or placed into a subprime loan. And you might ask, well, these are individual things. How would you know? remember that this is coming up through HMDA data. You can trace that. That has to be reported, right? When you have to report everything, then a pattern begins to develop, and someone will look at this pattern and say, "Ooh, there's something going on here in this area that looks very much like it could be a disparate treatment, disparate impact case." And then you had the Sederberg versus Northwest Priority Credit Union. Quite simply, she was denied a loan due to pregnancy. She said, "I'm going to go on maternity leave." And the bank said to her, "Well, if you go on maternity leave, then we can't count your job as income because it's not steady income." And so they denied her. Initially, they denied her the loan. Later, they went ahead and approved the loan, right, or put her through the loan process. But they denied her because of credit. Unfortunately, the damage was already done. She had the initial denial. Now, you'll hear attorneys, they'll come up and say, "Well, no, she wasn't denied because they eventually put her through the process and gave her the loan." That loan was denied. And according to everything that I've ever read in my 20+ career doing this, is that when you delay the approval, or when you delay someone's access to the process, the Fair Housing Act says it's as good as a denial. Right? And so justice delayed is justice denied. And so that's what I mean when I say the damage was done. They had already denied, and therefore, even though you put it through the process, you can't walk back that denial because there was a different, and then you had direct evidence. The person said, "Because of your maternity leave, I'm probably not going to be able to use your job income as income." So that begins to kind of put the picture to you as to how that happens. Let's see here. Let's talk a little bit about affirmatively furthering fair housing, because it all kind of gets into what we're talking about. When we talk about fair lending, and we talk about Fair Housing Act, and we talk about ECOA, we talk about CRA, the HMDA data, all of these fall under the umbrella of affirmatively furthering fair housing. But before I get into that, let me go back to the beginning. The Fair Housing Act, which was enacted in 1968, was enacted to end housing discrimination and promote diverse, inclusive communities. Right? And we do that through enforcement, we do that through trainings and outreach events. And we, as a society, have done a great job of that first goal. What we have not done well at is the second goal, which is to desegregate neighborhoods. And that is known as affirmatively furthering fair housing. Right? So providing equal access to individuals. And how do we do this? Well, it wasn't until 2015 that Obama kind of gave us a real good definition that stated that taking meaningful actions, in addition to combating discrimination, that overcome patterns of segregation and foster inclusive communities free from barriers that restrict access to opportunity based on protected characteristics. So that's the definition that we're currently under, because just like in the Trump administration, they reviewed the disparate impact. They also reviewed and walked back the AFH rule, the affirmatively furthering fair housing rule, which basically it provided a simplified definition, which is anything done to promote fair housing is affirmatively furthering fair housing. That was literally the definition that the Trump administration had at that time. And so both sides of the equation, right, people in favor and people against, had their own spin as to what that meant. Some people said, well, he basically gutted affirmatively furthering fair housing. Other people, like myself, I saw it as, yeah, you could say he gutted it, but he also gave an agency like ours, an enforcement agency, he opened the doors wide open. I can accuse anybody of affirmatively furthering fair housing violations because you didn't promote fair housing in allowing this person to rent. And so you could look at it in both ways. But more precisely, affirmatively furthering fair housing is designed or was designed to get rid of the systemic ills of discrimination. So when we look at dealing with discrimination cases on a one-by-one basis, we're taking care of that one or two, one individual's discrimination that they file, we're taking care of that individual case. But when we're looking at affirmatively furthering fair housing, we're looking at systemic changes that lead to making sure that we desegregate neighborhoods and foster inclusive communities free from barriers. One of the ways that that happens is through the analysis of impediments to fair housing choice, or the assessment to fair housing. You know, creating the capers that we basically as county officials and or city officials would look at and say, okay, well, here are the impediments to fair housing choice that exist in our community. Here's how we're addressing them. And one of the biggest barriers that the Obama administration had was it was a one-size-fits-all kind of approach. And if you're living in a Commonwealth like the Commonwealth of Pennsylvania, that really doesn't work because we govern from the bottom up. And so we have to look at how do we address what we need to do and affirmatively further fair housing. And so what I've proposed many times to counties, and as I worked with Lancaster County and York County, create 3 buckets. You create the bucket that you're directly responsible for. These are the things that we believe, these are the barriers that exist, and here are the actions that we can take directly to address these barriers. Then you have your second bucket, which is these are the barriers that we see, and these are the barriers that we can partner with other organizations on to ensure that we're addressing this as a community. And then you have your third bucket, which we believe that these are barriers that exist. However, because they're not within our control, we can advocate for addressing these barriers. And that would have made it easier, I think, for all counties and all cities across the Commonwealth to be able to address and not kind of feel like, well, I know I did this, or I knew I was part of that, but how do I address it in this matrix that they sent? But that's one of the ways they do it. The assessment to fair housing choice is another, but also these lending programs that are out there are also other ways to do it. There are also programs, and we saw this during COVID, that allowed for people to get help, people that were being evicted or people that needed assistance with their mortgages because, you know, COVID had closed everything down. When we look at those opportunities to be able to keep people in their homes or to have people access homes by removing barriers, that in itself has an element of affirmatively furthering for housing. So there's a lot of good things that are going on in the Commonwealth with regards to this. I think that working together, we can probably find some more ways. Here's something else that affirmatively furthers fair housing, right? It's called special purpose credit programs, and it's basically targeted lending products designed to specifically advantage an economically disadvantaged group of people. So let's go back. Affirmatively furthering fair housing, that second goal, the reason it was there is because in the 1930s, you had the HOLC map, these redlining maps that were put into place, and they would judge and gauge the loan risk value. And so they would look at a red area and they would judge it by saying, well, there are a lot of African Americans in that neighborhood, so that for us is a very high risk neighborhood and we're not going to go in there. Then you had your yellow maps, which is a yellow colored map would be a declining because it's too close to those areas that have people of color or immigrants. Then you had your blue area, which was almost at the top of the line, and you could certainly assume some risk and you can lend money there. They're stagnant, they're non-moving areas. And then you have green, which was the very best areas to loan and the better opportunities. And so when you look at this map in the 1930s and you think about the people that are being denied loans and being denied the opportunity to buy houses or to live where they can afford to live, you can see that there's a pattern that exists that has basically permeated throughout the years there. It is responsible for the wealth gap that currently exists. It is responsible for the education gap that currently exists. It is responsible for the health gaps that exist. And there was no greater example than to watch all of these gaps float to the surface during the height of the pandemic. And we found that people that were historically disadvantaged were, again, marginalized. Let's think about education for one moment. When we look at education and redlining, we find that many places where the schools are severely underfunded, unfortunately, they end up lining up squarely within those projected redlining. You could almost overlay a map over it and you find it. There's a site out there, and I'll see if I can share it. There's a vulnerability index map out there that kind of, you look at the redlining map for Harrisburg, for example, and you look at that vulnerability index map and you put them side by side, and you see that the vulnerability of people that may have a food desert or may have lack of housing, lack of education or poor education or poor disinvestment lines up directly with the redlining maps. Is that coincidence? Or is that just the way it's happened because we started on the bad foot, as they say? So fast forward to affirmatively furthering for housing in 1968, had we put these and put an emphasis on affirmatively furthering for housing and ensuring neighborhoods of opportunity and diversity without barriers, then the story at the height of COVID might have been different, right? The health gaps, the wealth gaps might have been different. And so really, when we're looking at these programs, when we're looking at discrimination, at least when I look at it, I'm looking at it from a systemic view. I'm not saying that the system is racist, not by any means. What I am saying is there's an historic accounting for which we've not remedied. We've not remedied that historic accounting. And so these programs, like the special purpose credit programs, are efforts to try and address some of these gaps that exist. So these special purpose credit programs were allowed in 1974 to counteract previous discriminatory laws and policies. And you might be saying, well, 1974, I mean, where was this program before? And what ended up happening is that there was a thought within the lending industry that said, how is this not discriminatory? If I target lending products to these individuals, I'm going to be accused of being discriminatory. And so it actually took a statement from the Department of Housing and Urban Development and Department of Justice last November, I believe, that basically they issued guidance stating that special purpose credit programs are consistent with fair housing laws, provided that they are implemented correctly. And these special purpose credit programs may be offered by nonprofit or for-profit organizations. And so what does that include? Well, that includes maybe the ability of using somebody's rental payments as a way of it within their credit score, or using the way they pay their utility bills. And again, if you recognize every program out there could have a negative effect. So these are programs that need to be examined constantly to ensure that they're being applied correctly. All right. The first-time home buyer programs, as I mentioned before, is another way of being able to affirmatively further fair housing and guarantee people have access to home ownership, where maybe through the conventional means they may not have that access. First-time home buyer programs can increase access to home ownership through housing, counseling, and financial assistance. The programs are important in reducing home ownership and wealth gaps by providing tools, knowledge, and financial assistance to help households build equity through home ownership, and thus be able to share the wealth with their children. And why is that important? Well, let's go back in history a little bit and look at the GI Bill, the origins of the GI Bill. If you were African American and you didn't finish school, that GI Bill, after coming home from the war, where you risked your life for this country, you come back and you have this GI Bill, because all the military personnel got it, except for the fact that if you didn't finish school, you're not going to be able to go to college, right? And you're not going to be able to apply. So the other place you could use that GI Bill was to buy a home. But now the home you want is an area where they won't lend to you. And so it's almost the equivalent of you have this race and we have all had the opportunity to start this race, but the gun went off and we were told to wait, or individuals within protected class were told wait until one lap was run by everyone else, and then they let you run. And so we're playing catch up. And catch up is only good on fries. So that's basically how I like to break that down, just to kind of give that analogy. The other one, and the newest one, is the Property Appraisal Valuation Equity Task Force, PAVE. And so HUD put this task force together. They basically wanted to look at fair and accurate home appraisals are crucial to addressing homeownership and wealth gaps. So the PAVE task force, which was basically put together by 13 different agencies providing recommendation for ways to address equity and accountability within the appraisal industry. You know, one of the things that few people know is that when you look at the appraisal industry, there are virtually no women in the appraisal industry. All male, pretty much all white. I think they said 83% of the people within the appraisal industry are white. Very few people of color. Does that have a bearing? I can't tell you that it does. I'm a former investigator, so I would have to investigate to see if it does. But it could certainly add, and especially according to the training that I just took, it could certainly skew things. You know, we all have our own biases, right? We all have affinity bias. You know, if you went to school and you pledged a certain sorority or a certain fraternity, when you find a brother or sister, there's going to be a camaraderie there that isn't with someone else that didn't pledge that. So we all have that. That our task is to, okay, how do we prevent from those biases from bubbling to the surface to a point where it actually affects a decision being made for lending or for housing or what have you. So that's the how do we navigate our own humanity, right? To be fair with each other. So here we have a lot of the resources that I talked about. Disability and lending is in there. The maternity leave is in there. Language access, special purpose credit program toolkit is also included in this, and the PAVE task force. And I've made a commitment that I'll go ahead and send you the information for the information for the have mercy, for the bias, the appraisal bias, because I do have that. I just took that at the beginning of the month. So at this point, I'm going to ask if you have any questions. We can have a conversation and you can ask any question you want and try and answer it for you. And while we wait for some questions to bubble up, if you look at that QR code, you would do me a favor, take your phone and take a picture of that QR code and you can answer those survey questions. We'll go ahead on also, I think we're asking for your name at the end of that survey so that we can send you a certificate. So if you could take a couple of minutes, go through that survey. I think it's 10 questions, no more than that. And then we can get you that. And then for anyone else that may have a question, I am available to answer those. Is there anything else that you wanted to see covered that I didn't cover?
Not that, Adrian, this is Lisa. I want to thank you for helping us with this seminar and, apologize. We didn't have that much of a turnout. Our hometown CMB did though participate, and that's wonderful. Thank you, Alyssa. And I did ask that it be recorded, and I'm going to take the liberty at sending the recording out to all of the